Imagine waking up to find that one of the world's most powerful nations has quietly pulled the plug on thousands of tons of silver flowing into global markets, while at the same time scooping up record-breaking amounts for itself. No flashy announcements, no panic in the headlines, just a strategic shift so significant it could ignite the kind of silver price surge most investors have only dreamed about. This is the silver moonshot no one saw coming, and today we're exposing exactly how China's record imports are rewriting the rules. What you're about to hear isn't speculation or hype, it's the unfiltered story straight from the numbers, the customs data, and the quiet moves happening behind closed doors. For years, we've watched gold and silver prices climb, often brushing it off as just another bull market or geopolitical noise. But beneath the surface, something far more structural has been unfolding, something that accelerated dramatically in the last couple of years and reached a breaking point in 2025. The West kept selling, convinced prices were too high. China kept buying, and now their imports have exploded in a way that caught everyone off guard. Let's start at the beginning, because the contrast here is everything. For the better part of the last decade, China played a very different role in the global silver market. They weren't just a buyer, they were a major supplier. Every year, reliably, they exported somewhere between 3.5 and 4,000 tons of silver into Western markets. That's not pocket change. That's a steady stream that helped keep prices in check and maintained the comfortable illusion of abundant supply. At the same time, their own imports were modest, nowhere near matching those exports. It looked balanced on paper, it felt sustainable, but it wasn't. The reality was more complicated and more revealing. China's domestic silver production from mines and refining didn't even cover what they were shipping out. To keep those exports flowing, they were drawing down their own stockpiles. They were essentially subsidizing global supply at the expense of their reserves. Why? To maintain control over prices and keep the market stable on their terms. It worked for years. Western demand stayed high, especially from industrial users, and China played the quiet exporter role that kept everything humming along. Then 2025 hit, and everything changed. Almost overnight, China stopped the exports cold. That 4,000 tons a year simply vanished from the global pipeline. No more silver heading west from Beijing. At first, it seemed like a minor blip, maybe tied to the same kind of rare earth restrictions that made headlines when they limited supplies to certain countries. But this was different. This was silver. And the timing couldn't have been more telling, because right as exports dried up, China's imports didn't just tick up, they detonated. Last year, their imports sat at around 360 tons. Respectable, but nothing earth-shattering. Fast forward to this year, and in the first 3 months alone, they brought in 860 tons, 10 times the previous pace when you annualize it. The charts show it clearly. Bloomberg data circulated quietly among analysts. Suddenly, the world's largest silver consumer wasn't just holding steady. They were hoarding at a pace that shocked the market. And the reasons go far deeper than simple opportunism. First, there's the strategic angle. The United States has officially labeled silver a critical mineral. That designation matters. It signals that Washington sees silver as essential for defense, technology, and energy security. China understands exactly what that means. Why would they keep supplying a metal the Americans now consider vital, especially when tensions are high? They wouldn't. They stopped. They began pulling it back home instead of letting it flow into stockpiles that could end up strengthening their competitors. But the bigger driver is internal demand, and this is where the story gets urgent. China's photovoltaic industry, the solar cell sector that's powering their massive green energy push, is consuming silver at unprecedented rates. Silver is irreplaceable in high-efficiency solar panels. It's not just a nice-to-have, it's a core component. Demand inside China has been accelerating so rapidly that authorities recently did something remarkable. They told solar manufacturers to slow down production, not because the market was weak, because silver stocks were getting tight. Think about that for a second. A country known for pushing manufacturing to the limit is hitting the brakes on one of its flagship industries to protect silver reserves. That's not a minor adjustment. That's a signal of real pressure. And China isn't alone in feeling this pinch. India has been ramping up its own solar ambitions for years, partly to offset the massive coal power expansion. 2 years ago, they decided to boost photovoltaic output, which means they now need to import nearly all their silver. two major economies, both racing towards solar dominance, both suddenly competing for the same finite physical supply. The math doesn't lie. When supply contracts and demand surges at the same time, the pressure builds fast. Now let's zoom out, because this silver story doesn't exist in isolation. It's colliding with something much larger that's been brewing for decades. The fiat currency system, the one we've all lived inside for so long, is hitting its natural limits. It's built on credit, on constant expansion, on the assumption that tomorrow will always be able to pay for today. For years that worked because confidence held. People trusted the institutions, they trusted the paper promises. But confidence is eroding, slowly at first, then in noticeable waves. When that happens, money starts looking for a home outside the credit machine. It looks for something real, something with no counterparty risk, something that can't be printed or diluted at will. Physical silver and gold fit that description perfectly. They are not claims on future value, they are value. And China gets this at a level most Western analysts still downplay. While markets obsess over paper futures, ETFs, and derivatives that create the illusion of endless supply, China is focused on the metal itself. They've been accumulating aggressively, not just in gold, but increasingly in silver. The divergence between paper markets and physical reality is widening, and that's where the real opportunity and the real risk sits. Think of it like this. For years, the West told itself silver was overvalued, that supply was plentiful, that industrial demand would always be met. Meanwhile, China was quietly doing the opposite. They were the ones filling their boots while the rest of us sold. They understood that silver isn't just an investment, it's a strategic asset with dual roles, monetary and industrial. When both roles heat up at once, the price impact is exponential. Technical analysts have been calling this for a while. Michael Oliver, for one, has been mapping out the charts and fundamentals pointing to a silver moonshot. He wasn't guessing, he was reading the signals most people missed. And now the underlying data backs him up completely. The export cutoff removed a major cushion from the market. The import surge is tightening the noose further. Add in the photovoltaic boom, the critical mineral status, and the broader flight from fiat, and you have the perfect setup for a structural shift that could catch the entire investment community flat-footed. But here's what makes this moment so fascinating and so dangerous for anyone still sitting on the sidelines. This isn't some short-term frenzy driven by headlines or retail FOMO. This is decades of monetary distortion finally slamming into physical reality. Paper claims can multiply, physical metal cannot. When enough people or enough nations start demanding actual delivery instead of rolling contracts or settling in cash, the system gets tested in ways it hasn't been for generations. We've seen glimpses of this before, market squeezes, temporary shortages, but never on this scale, with a player as dominant as China orchestrating the move. Their actions aren't random. They're calculated to secure supply, protect reserves, and position themselves for whatever comes next in the global monetary reset that's quietly unfolding. The rest of the world is still operating under the old assumptions. Paper inventories look fine, exchange data looks stable, but those numbers don't tell the full story. They don't account for metal that's being locked away in national stockpiles or redirected into domestic industry. The contrast couldn't be starker. On one side, you have futures markets and derivatives creating layers of supply that exist only on screens. On the other, you have China physically removing supply from circulation and adding massive new demand. That imbalance doesn't resolve gently. It resolves with price discovery that reflects the real world, not the paper one. And when it does, the adjustment tends to be sharp, fast, and unforgiving for those who ignored the signals. So what does this mean for silver specifically? It means the moonshot isn't hype. It's the logical outcome of supply contraction meeting demand explosion at the exact moment when confidence in fiat alternatives is growing. Silver isn't just going to rise. It's going to reprice in a way that reflects its true scarcity and strategic importance. The same dynamics apply to gold, of course, but silver carries that extra industrial torque that could amplify the move dramatically. None of this is about panic. It's about clarity. It's about seeing the structure instead of the noise. The equity markets might hit new highs on excess credit. Bond yields might look manageable, but underneath it all, the debt trap is tightening. Inflationary pressures from commodities and geopolitics are building, and physical metals remain the one asset class that has served as real money for thousands of years, immune to the counterparty failures that plague everything else. If you've been watching the silver market, you've probably felt the tension building, the quiet accumulation, the sudden policy shifts, the disconnect between what analysts say and what the data shows. This is that moment when the pieces snap into focus. China's record imports aren't just a data point. They're the exposed nerve of a much larger transformation. The silver moonshot is no longer a question of if. It's a question of when the market finally wakes up to the reality China has been preparing for. And that's exactly why paying attention now matters more than ever. Not because prices are guaranteed to double overnight, but because the fundamentals have shifted permanently. The old playbook no longer applies. The new one is being written in real time by the flows of physical metal and the strategic decisions of major powers. Those who understand this shift early position themselves accordingly. They diversify intelligently. They focus on real assets. They avoid the trap of staying fully exposed to a credit system that's running out of room to maneuver. The story of silver right now is a masterclass in patience meeting preparation. China didn't broadcast their move. They simply acted. They stopped exporting, ramped up importing, and protected their interests in a world where silver is becoming both more valuable and more contested. The West is still catching up, but the data is out there for anyone willing to look past the surface narrative. By the end of this, one thing should be crystal clear. What we're witnessing isn't random volatility. It's the inevitable collision of monetary policy limits with physical constraints. Silver's dual role as money and industrial metal makes it uniquely positioned for the next leg up. China's actions have accelerated that timeline. Their record imports have exposed the fragility in the old supply assumptions, and the moonshot that technical analysts have been forecasting is now supported by hard, undeniable fundamentals. Stay ahead of these shifts. Keep watching the physical flows.